All these women here.
What's that?
Look at all these women.
I know, it's good.
Good afternoon, everyone. Welcome to our seminar on managing capital flows. What is the right policy mix? You know, I think it's virtually every spring meeting and annual meeting we have a discussion about capital flows, about their impact, about how to respond to them. I think we've advanced. I think we're off to a good start. But I fear to say that the end is not yet in sight. So I'm hoping that today's discussion will move us in the right direction. This is a subject that the fund works on, academics work on, policymakers think about and have to contend with every day, even though answers are not yet clear. Here we are today in the atrium, which is like our center court, and we have some real champions for you today. We have a panel of central bank governors who have thought about this subject and contended with this subject. So let me say a few words to set the stage for the discussion, and then we'll move on to some questions. Just before, since I'm sure we will spend most of the time talking about the problems that come from capital flows, let's just remind ourselves that we talk about capital flows because we think that capital flows can be a very good thing, that the reason that we allow capital flows in the world is that for developing countries, emerging market countries, attracting capital that contributes to growth can help spur productivity and growth and convergence of living standards. But I think more and more we are seeing that those benefits may come with risks, and that some policymakers may conclude that, at least in some settings, the costs may outweigh the risks. I think we've also seen that the global circumstances have changed and evolved in ways that call into question some of the earlier orthodoxy about free capital flows. We are living in a world of greater financial integration, a world where in the major countries, in the advanced economies and major currency bloc areas, interest rates have been very low for a very long time, and where unconventional monetary policy is being practiced, and that's changing market circumstances. This is all, I think, creating new challenges for policymakers to contend with. They're contending with these global factors. They're contending with volatile capital flows. Those are what Mark Carney likes to call the push factors, what emanates from outside of an emerging market country's perspective. We're also contending with more benchmark indices and changes in the structure of capital markets, what Mark calls the pipes. And this is leaving emerging market and developing economy central bankers thinking about how best to get whatever benefits one can, but also how to insulate oneself from shocks. We tend to think also of exchange rates as shock absorbers. That's been our orthodoxy. I think we are seeing in some circumstances that exchange rate can be shock amplifiers or shock transmitters. I think in this new setting, it's well worth reconsidering all of our views. You know, we've had here for years the institutional views on how to manage capital flows, and we stick with that. But I think along the way it makes sense to have discussions like this, to be open-minded, to hear what policymakers have experienced, what their objectives are, and how they intend to go forward. We are trying to do that ourselves on fund staff, thinking more broadly even than capital flows. When we say getting the right policy mix, we have to consider other policy areas, how monetary policy, foreign exchange intervention policy, macroprudential policy, and capital flow management policies may all fit together. What's the right mix? What are the trade-offs? So today, let's turn to our panel. I think we have a great panel to address these issues. Let me introduce, I'm sure most of you know everyone here, but let me introduce our panel. First, we have Stan Fischer to my left, who's had a long and distinguished career, not just here at the IMF, but as vice chair of the Federal Reserve from 2014 to 2017, and before that, governor of the Bank of Israel from 2005 to 2013. I have a different order. Mark Carney is governor of the Bank of England since 2013 and is also the first vice chair of the European Systemic Risk Board and was governor of the Bank of Canada between 2008 and 2013. Elvira Nabiullina is governor of the Central Bank of Russia, has been since June 2013. Before that, she was advisor to the president of the Russian Federation for Economic Affairs and held ministerial posts as Minister of Economic Development and Minister for Development and Trade. And sitting next is Raghu Rajan, the Catherine Dusek Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He was governor of the Reserve Bank of India from 2013 to 2016 and was here, of course, as counselor and director of research here at the IMF. And then we have Governor Nur Shamsia, governor of the Bank Negara, Malaysia, appointed just last year, an alumna of the IMF, and had a career before that at the Bank Negara. I think it is interesting that we have 2 out of 5 who have served in 2 central banks, and we'll see, Mr. Rajan, whether you want to make that 3 out of 5 at some point.
Yeah.
Let me start with you, Stan, since you've been in 2 central banks and you've contended with these issues. I think you're in a position to tell us how you're thinking about this subject. I know when you were here, you had views about, to some extent, dubious about the benefits of unrestricted capital flows and of totally free exchange rate movements. How now, as a practitioner, your views have evolved and what experiences you'd like to share?
Okay, well, first of all, thanks very much for inviting me to join this distinguished panel. The class of 2013, you could say, since 4 out of the 5, if I listened carefully enough, started their jobs in 2013, and fortunately we have somebody who's more up to date than we are, Shamsia, the governor of Malaysia. I want to talk mainly about my experience with capital controls, and it'll be a historical memory dump. When I came to the Bank of Israel, they had not intervened in the capital markets for 10 years, and the standard story was, this policy has served the bank well. Well, I knew those lines from the fund because we used to say that about some policy that we weren't absolutely sure was the best policy, but it seemed to be working. And so that was the sort of thing you would see in IMF reports on countries from time to time. But that was the line, and it seemed to be true. There were no foreign exchange crises during those 10 years, and everything was fine. The one criticism we got was from the rating agencies, who used to come along and tell us all the time, you don't have enough reserves. And then we'd say, well, this policy has served us well, who knows, etc. And that's what we said. And then the crisis came. Well, at the beginning of the crisis, everybody reduced their interest rates. We had the good luck, for technical reasons, which I won't go into, of we, the Bank of Israel, of actually reducing our interest rate to 50 basis points the day before the G7 did it. It had nothing to do with the G7, but everybody in Israel was persuaded that the G7 had looked at what we did, and bang, the next morning, there it was.
Certainly helped.
Huh?
It certainly helped.
Yeah. So there we were, and the interest rate was going down, and we were still getting a lot of capital coming in. And that went on for several months. Why did it go on for so long? Well, I concluded that if that was what we were doing, we'd better have to intervene. And incidentally, we'd in that way be able to raise the reserves and deal with one of the critiques of what we were doing. But here is a problem. If you're legally the sole decision maker in a bank, as the governor was in the then Bank of Israel, but the sole decision maker and the only one that anybody agrees with, it's going to be very hard to change policy when everybody who has to carry out the fixed exchange rate policy disagrees. So we worked on it, that is, I worked on it for several months, and I remember being in that place which has a lovely lake with a lovely hotel in it in North India on some official visit, and spending all my time inside the room arguing about the exchange rate with my people in Jerusalem. And then as the flows kept coming in, we decided we've got to do something about it. We didn't want to go to negative interest rates. Maybe that was a mistake, but we didn't. And eventually, more and more people thought that made sense, and we decided to go for intervention in the exchange markets because we thought that if we didn't intervene, we'd be forced into negative interest rates. We didn't want that. And I think it happened in February or March, whereas we'd reduced the rate to 50 basis points 3 or 4 months before. Once we had it, we had to figure out how to run it. And that is not that simple, especially when there are offshore markets and people can run around you, so to speak, if the foreign capital markets fundamentally disagree with you. So we had to do a lot of little tax-like measures in order to make the thing work, and we managed to figure them out. Although every now and then somebody would come and tell me how you could get around them, and then we'd have to find another way of getting them, making it possible. Once we got there, then the next question was, well, when are you going to give this up? And so the statement well, I better not tell you what I used to say then. The answer was, we'll give it up when it's not necessary any longer, and they still haven't given them up. And the reason they haven't given them up is that Israel's balance of payments situation improved significantly with the discovery of gas, natural gas, and with the improvements in the export performance. And we still didn't think that with an appreciated exchange rate, we'd be as happy with what was going on in the economy as we were with what we had when we were intervening. So then I asked myself, now, why is it that I'm not allowed to intervene? What is the theory that says you don't intervene and that that's a good policy? And I concluded that the agreements that were among the large players, and they were essentially that if big country X intervenes, big country Y may be forced to intervene, and then it will really distort the pattern of exchange rates in the world economy. And I concluded that this was not going to have a big effect, our intervening, on the world economy, except as enabling people to say, even this one is a typical, this is when you know you've gone too far, even Fisher is now intervening. That would be sort of my problem. But that's what happened. But anyway, we kept intervening, and I think so far it's done pretty well. There's a special provision, the way the interventions for dealing with the natural gas receipts are different from the interventions, the other interventions, and they seem to be working okay. So what went wrong? What would have gone wrong? Well, the thing could have broken down. We could have had this system and we could have lost control of the exchange rate. We didn't, but we had to scramble from time to time. And it worked. And then I couldn't quite see why we should give up with it, give it up at this stage. So that was in 2009 that we introduced them, and it's 10 years since then. And the central bank still is intervening, although less and less, and mainly to deal with the problems of the revenue from the gas. So we did not intervene in the sense that the market was too volatile. It was too volatile at the beginning, and we intervened. But by now, the market is not especially volatile, and the central bank continues to intervene, and its intervention to affect the rate of to affect the interest rate. So it's almost certainly what the fund doesn't approve of. Again, then you have to say, well, if you're doing the wrong thing, what's the damage? And I must confess, I can't actually figure out what the big damage is from doing what the rules say don't. So I'll stop at that point.
Stan, let me follow up on your points and ask, were there episodes where, have there happened to be during this time, episodes where the country needed a change in its real exchange rate and intervention policy had to decide how to allow that to happen, how to accommodate that, or for a period resist that? If so, how was it handled? If not, how generalizable is your recommendation?
We very rarely intervened without the exchange rate moving. If everything was fine, that was fine. We didn't intervene. But when there were large movements of money coming in, we would change the amount we intervened, and that was the answer to that question. So I'm sure if we try to keep the exchange rate fixed, the reserves, which started at $26 billion and are now about 140, would have been much larger if we hadn't let the exchange rate move somewhat. But we didn't let it drive us to wherever it wanted to go.
Thank you. Let me turn to Governor Nabiullin. Elvira, as governor of Russia's central bank, you have to contend with, from time to time, substantial changes in the terms of trade, as well as inflows and outflows of capital that are based on sentiment, as well as sanctions and other issues. You've maintained a fairly straightforward inflation targeting, flexible exchange rate approach. Maybe you could say a few words about how this has worked for you and how you see the role of macroprudential and capital flow measures in your setting.
Indeed, in the last 5 years, Russia has lived through several waves of capital account shocks. Sometimes they were aggravated by terms of trade shocks. It's quite usual for commodity exporting countries. As a result, Russian economy has deleveraged significantly, and our external debt has decreased by almost 40%. And what are the main lessons? I think neither free-floating exchange rate regime nor an absence of domestic imbalances nor accumulating the buffers cannot fully insulate the economy from shocks. However, these three factors can help to increase the resilience to shocks. We used almost all of these tools from policy mix, except capital flow management. I think that capital flow management and capital control is useless and even dangerous during the phase of ongoing massive capital outflow. But in general, central banks are more limited in their choice of instruments at the phase of capital outflows than at the phase of capital inflows. And interventions in currency market at the stage of outflow can be interpreted as the attempt of central bank to defend a particular exchange rate. And our experience shows that it can even provoke more panic than calm down the market sentiment, because it provokes more speculative behavior, if you want. And we use monetary policy, and we used it in late 2014. And whatever theory says, I think almost everyone uses it not as only as a tool for policy stability goal, but as a tool for financial stability. In practice, increasing interest rate can decrease foreign capital outflow and can prevent further dollarization of savings. It's important for emerging markets. But monetary policy tools, increasing interest rate, can be used and is often used when capital outflow risks are already unveiled. In my view, it's more appropriate to take precautionary measures at the stage of inflows. I mean macroprudential measures and building buffers. And the most important thing, I think, it's debt sustainability. The leverage should be under control at all levels: government level, household level, corporate level. We use fiscal rule to control government debt. We use different macroprudential measures, including LTV, high risk weights on consumer lendings, DTI. For us, more trickier how to use what instruments we can use to control corporate debt. For example, we study now the approach used by France. They have these higher risk weights on banking lending to large indebted companies. But even this approach cannot it can only insulate banks, but not the whole economy, because companies can easily borrow from abroad or from financial markets. But I think it's very important on the global level to think about these instruments, how to control this corporate debt. Why this leverage is important? I can show the example of Russia. For example, we had quite a high share of foreign holdings of our government debt. It's about 34%. Last year, it fell sharply to 23% because of external factors, and we saw a spike of market volatility. But since the overall government debt is quite low, it's less than 20%, this effect on market was limited and short-lived. That's why I think that sustainability is the main and the first defense of financial stability. I said that we are very reluctant to use different methods of interventions in financial market, because we had a long history of these interventions of managed exchange rate. We think it's better to have these precautionary measures. And for capital control, I've said I think it's useless, and it can decrease the openness of the economy, and moreover, it undermines the investors' confidence. And even if this capital control has a short-term stabilization effect on the markets, long-term lasting effect is, I'm sure it's negative, because investment confidence, I think it's the main assets, is one of the main assets of central banking. It's the basis of its credibility, and that's why we have plenty of instruments, but without this capital control.
Thank you. Thank you very much. Governor Shamsia, I've heard you say that you've applied tools very differently in different circumstances. Yes. Maybe you could take us through some of the experiences that your country's had. I know this does predate your time at the central bank, and explain how you think about the subject.
Well, Malaysia is a very open economy. Trade accounts for 130% of GDP, and our bond market is deep and at the height of non-residents can hold as much as over 30% of our Malaysian government bonds, and in our equity market, non-residents hold 30% of equities. So under this context, we have experienced volatile, technical-driven, sentiment-driven flows. For example, after the QE, whatever inflows that we have accumulated over 3 years, reversed out, 30% of it reversed out within 3 months. In 2018, whatever inflows that we had accumulated in the first quarter of 2018, all of that flew out within 18 days. So it's extremely volatile. So for us, the policy mix that we employ depends on the risk that is being managed at that point of time. Give me an example. In 2015, when oil prices declined by 70%, and Malaysia is seen as a commodity-dependent economy. So we experienced what we call a terms of trade shock. So under that circumstances, the main policy that we used was the exchange rate was the main shock absorber. As a result, our ringgit depreciated by 30%. Fast forward to 2018, and you had all these fears about emerging markets. And on top of that, managing the contagion from the emerging market, we also had an unprecedented election results where for the first time in 60 years, there was a change in government. So investors' confidence at that point of time was very fragile. Not just investors' confidence, but there was a lot of policy uncertainties because the country has undergone something that had never been experienced before. So under that circumstances, ringgit, allowing the exchange rate to be the shock absorber can be a shock amplifier. So the main policy response for us at the point of time was to employ more and more FX intervention so that we manage this excessive volatility so that any sentiments does not become self-fulfilling. So the main policy that we used to manage the capital outflow at the point of time was FX intervention, compared to the episode in 2015, where the magnitude of the outflows were about the same, where the main tool that we used was to allow the exchange rate to be the shock absorber.
Thank you.
So initial conditions matter, the risk and the environment matter, but the important thing is for us to be clear what was the source of that risk and what is the most effective tool to manage that risk. And I think the credibility of the central bank can still be retained under that discretionary framework, so long as the central bank has a record of being clear of what the risks are, what are the policy tools that will be employed, and more importantly, the outcome that the central bank is able to deliver in terms of its mandate. For us, one of the mandates is financial stability, and how we define financial stability is we manage that the financial stability risk so that the money market and the FX market remains orderly to facilitate real economic activities.
Right. Thank you very much. So far, Raghu, the three have talked about the reactions that individual countries have and how they might act. I know as governor in India and since then you've been saying that we shouldn't just think about what the recipient country should do, but we have to take a much broader, more global perspective, taking into account where these spillovers come from in the first place. Maybe you could say a little about what your thinking is on this now.
Sure. I think it's important to reiterate what you started with, that capital flows are generally a good thing, and we want to use them as effectively as we can. And in that process, we have to consider the volatility of capital flows, the timing of capital flows, and how best they can serve the purpose of financing for investment. Now, just a short recap of where we were and where I think we're going. We were in a situation where we essentially were of the view that so long as each one kept their own house in order, the global financial system worked quite effectively. And that meant for individual countries, if in fact you faced a large inflow of capital, you used a combination of monetary policy as well as allowing the exchange rate to move in order to absorb those flows. So long as you did the right thing, it was all balanced, everything was hunky-dory, the system worked. Well, it turns out that it's not as easy as that, as we've heard the previous panelists say, one of the problems, if you have a sustained period of very accommodative policy, is that capital flows respond, capital flows go searching for yield, and the timing of when those capital flows come in and when they go out are not entirely up to the country receiving. They often are based on events elsewhere. Accompanying this capital flow is a well-documented sequence of rising domestic exchange rates in the receiving country, combined with rising leverage levels, simply because the way it often comes in is not as equity, but as debt. The key problem is ultimately with leverage, because once it comes in as debt, it becomes a really hard claim, and when it wants to go out, you either find every which way to accommodate it leaving, or it creates problems domestically. So as a result, these kinds of flows, it's a great mistake to treat them as permanent and to try and do everything you can to absorb them. You've seen that many of my co-panelists have essentially adopted the policy of trying to build buffers at times these flows come in, but also to try and make sure the exchange rate doesn't move too much with the flows, in part because of what David said earlier, that there seemed to be not the usual sort of traditional view that if you allow the exchange rate to appreciate, it tends to restrain more capital inflow. In fact, it often does the opposite. Allow the exchange rate to appreciate, it draws in more flows, and it becomes a positive feedback loop rather than a negative feedback loop. So it's this combination of rising exchange rates, higher leverage, and greater vulnerability, which I think the emerging markets have been trying to resist. Now, of course, when you look to where it is coming from, often it is driven by easier monetary policy. Now, obviously, that monetary policy, the aim of that monetary policy is not wrong in any way. It's about elevating growth rates domestically, but it has spillover effects. And increasingly, I think we're asking the question, are the benefits domestically of higher growth and then the spillovers of that higher growth to the rest of the world, do they outweigh the costs of these spillover effects through capital flows and the rising leverage in other countries, which then has to be counteracted and eventually can create problems? So, to my mind, this actually is a conundrum for international organizations like the IMF, because as far as the rules go and as far as I understand them, what is prohibited is sustained, unilateral, unidirectional intervention in the exchange rate to gain a competitive advantage. We have much less a clear sense of how we deal with situations where there are positive domestic benefits of an action. So the intent is always those positive benefits, but there are negative external effects. And first, we don't know how to measure the relative weights of those and how the costs and benefits trade off. But also, there are no rules in place saying we should behave this way or that way. And the reality is, perhaps it's time to start asking these questions. How, in fact, should we treat these situations? In general, it's a no-brainer when the positive effects are large and the external effects are small. But what if they're more balanced or they go the other way? What kinds of international responsibilities do we have? And I have to tell you that when I started raising the question of international responsibility, I think there's a lot of pushback. Maybe there is no international responsibility. That's a tough world to live in at this point, given the extent of spillovers.
Very good, thank you very much. Mark, you've been in the markets, you've been a governor, and you've been chair of the FSB, so you've seen this subject from a lot of different perspectives. Maybe you could offer some thoughts on how we as an institution ought to be thinking about the subject.
Okay, well first let me welcome this discussion and the work that the fund has been doing on these issues, and very much associate myself with the comments of fellow panelists. And just thinking about a bit of a framework to put it up there and then get discarded, but one of the things the fund's been at the cutting edge of is thinking about GDP at risk, capital flows at risk, and to some extent, that's what we're talking about. At a given point in time and through the cycle, how do capital flows and principally in good times, when capital is, if it is good times, it causes bad times, is what we're hearing, or can do, as capital's flowing in, what proportion of those are at risk, and what drives that? And as you alluded to this in your opening comments, and Raghu's just emphasized, there are three, I would say there's three buckets of factors that influence it. And one of the, start where Raghu left off, which is around what I would say the push factors, but basically the global financial cycle in both up and down. And to go to Stan's comments, I recall that period, and I recall the actions, both the rate cut and the intervention. And at the time, where there were few safe havens, Israel was a pretty attractive safe haven, which caused those problems. So the global financial cycle doesn't have to be just on the up. It's when it's on the down you can have these issues. Switzerland would be another example of somebody who's been affected by that. So the push factors, and this issue has become more poignant as the global economy has been reordered. And this room knows it, but the last time the Fed raised interest rates, the emerging developing world was a little more than 45% of the global economy. Now it's 60% of the global economy. And yet the relative weight of the US dollar and US dollar proxies has remained the same. And again, the fund is out in front in terms of the analysis around this, which has meant that these type of spillover effects, that asymmetry at the heart of the international monetary and financial system has become remarked. So there is this question of spillovers, spillback, and incorporating, and arguably it will become more pronounced with time, first point. Secondly, we need to think about the system as a whole. Where does that capital flow through? And think about the system in terms of pipes, if I can put it that way. So what influences the resilience of that system? The IMF's at the center, global financial safety net at the center, but also a big development in terms of the nature of the flows. Of course, the experience has been that FDI is a more stable, historically been a more stable form of inflow. Short-term bank debt has been a very unstable form of inflow. And the question is, where is asset management, so-called market-based finance, which has accounted for virtually all of the flows over the course of the last decade to the emerging world? Where does that fit on that continuum? I think that's an open question. That becomes a question not just for the jurisdictions from which this capital is coming, and 2/3 of that comes from the US, the UK, and Europe, but for the whole system. And so the FSB and the IMF need to, and think through, are there structural liquidity issues in these vehicles? Are they buying debt that ultimately very quickly does become illiquid, and they have daily liquidity, and does that mismatch matter, and does it matter for the volatility of capital flows? I think that's an open question, needs to be addressed. So that's the pipes bit. And then what we've been spending a lot of time on, and it gets a lot of focus, is the pull factors, the domestic factors, everything from microstructure and depth of markets, institutional credibility of the central banks, fiscal policy, macroprudential policy. And I think what the fund can do is to try to pull all this together and dimension. I mean, it's an ambitious task, so it's over to you. But
We'd like to have
and on the
homework.
brain trust here, you like ambitious tasks, which is right, and it's core to your mandate, I think, is to dimension these various factors and to put I'll just give one or two examples and then shut up. So there are times when the global financial cycle, the push factors are very strong or very weak. And having a view on where we are in that, which is something, again, here, a coherent and consistent view can be developed, informs policymakers domestically about the kind of risks that they could be facing, first point. Another example, though, is that one of the big links that's been mentioned by my colleagues on this panel has been what happens to domestic debt. Sometimes that can be fed from easy conditions of inflows, but it's also a domestic prudential and macroprudential responsibility. And I think you'll find in all these cases, I know is the case back to Stan's example in Israel, that the capital flow management or the intervention policy was matched by a series of tightenings in the domestic housing market. There were examples actually in both Russia and Malaysia as well. So that you start to move to an integrated framework and you're thinking about, on the margin, what's going to make the biggest impact. Last point, just to reemphasize, I do think as the financial policy makers, if I can put it that way, those around the table at the FSB and the IMF is there, need to think about the structure, not just of the banks and cross-border flows, but also of market-based finance and how it plays into these sets of issues.
Great. I think we've taken a good amount of time, but I think it's well worthwhile because you've all laid out an awful lot of, I think, sensible frames that have implications for what we ought to be thinking about. I think at the most ambitious level, what Raghu's suggesting, the question of the responsibility of the push factors, that's a difficult one. We've been thinking about it. But I do wonder, in light of what I've heard, whether we should be thinking about different policy ideas and approaches for recipient countries depending on what's the push factor of the moment. And it sounds as though, for example, if there's a commodity price boom and some real change that has to happen in Malaysia, in a sense, you let that have its ramifications. But when the push factor has to do with risk sentiment, which may be being affected by advanced country monetary policy stance or something, you might have a very different reaction. I guess my question, it comes back to something that Governor Shamsia said, which is whether central banks can have the credibility to not have a simple scheme, to shift gears and to say, we're going to do it this way in this state of the world with this push factors and this way in the other. I think, Governor Shamsia said you were able to square that, you were able to do that. I think, Stan, you were saying, if I understood you correctly, you mostly had events in one category, and so the issue didn't quite come up so much. The question is, and I think Governor Nabiulani, you said that especially when the credibility of a central bank is still being established, it's very hard to have that kind of differentiation. I wonder if people have reactions to whether the approach really can be, let's call it, situational.
David, can I also mention the macroprudential issue?
Please. Yeah.
I'm trying to think of what the framework is. It's sort of funny. We're talking about under what conditions is it permissible to intervene by acquiring foreign assets? And we haven't talked about the exchange rate very much. And the question is, what is the combination of exchange rate behavior and purchases or permission for foreign capital to come in that we like? And are there in fact three types, or is there just one type, which is more foreign capital may be problematic at many times? And I don't quite know how to answer that. But what does strike me is how do you stop? And that's part of the technology, that's part of the what are we managing and what are we managing it for. And I'm finding it very difficult to find the principle that we should be using, or the principles we should be using to decide when to deal with these capital flows. And is there any difference between that and deciding when to intervene in the foreign exchange markets, which this fund has discussed for decades?
I have thoughts on that, but you go ahead, okay. Mark.
Okay. Well, I think earlier on you said you raised, David, the real exchange rate, and I think this is a big component of this. And the question is there a persistent or a sustained change? Factors have changed that are driving the real exchange rate, and then there's a decision that has to be made of how that adjustment is taken, over what time horizon, and can you credibly influence the balance between on the spot exchange rate versus domestic prices? What could the policy choice, how could that affect domestic conditions? So you have pressure, be more precise, you have pressure for a real appreciation, either because something wonderful is happening in your country or something terrible is happening somewhere else, or some combination of the two. You have pressure and it's sustained. Do you take all of that on the spot exchange rate, or to what extent do you take some of it through domestic inflation? You know that, but the extent to which you're doing the latter, you're running looser monetary policy, what implications does that have for tighter prudential and macroprudential policy? Does that set of policies, is that coherent? Is it sustainable? And can you explain it? Which actually, we were talking earlier, if I may, I mean, this is part of the challenge, because if you can't explain it, then it's very tough to get out of it, and it's tough to retain credibility, because in the end, what you're trying to do, and I'll finish here, is you're trying to smooth an adjustment, not target a point exchange rate. And I'll give you a final imperfect example of this, because it didn't involve capital flow management. But post-referendum, there was a view that in the market, and it's understandable, that for a period of time, there would be a real income adjustment for the UK, a lower real exchange rate as a consequence of changing terms of trade for some period. That meant that had consequences. There's two ways to take that. One is through the lower real incomes could have been taken through higher unemployment or temporarily higher inflation. We tried to be very clear that we were going to choose the latter, stretch out the horizon over which we brought inflation back to target. But that was only operating in a couple variables, and what we're talking about here is operating in a few other dimensions. Right?
Others? Thoughts?
I think what you said, it boils down to, what Mark has said, the source of risk and what is it that you're trying to manage. An example was in 2016 of the US presidential elections. We saw that there's greater spillover from the OPEC NDF offshore markets into the onshore. And the offshore market had implied that the onshore rate should be 6% weaker than what the onshore rate was. And in that instance, employing FX intervention will not work, and allowing the exchange rate to move to that extent will be destabilizing to financial stability. So the only option that we could take at a point of time, especially when you have such high non-resident holdings of your bond market, was to employ capital flow management measure. And looking back, what we put in 2016 to reinforce the non-facilitation of NDF transaction was, fast forward to 2018, when we had that kind of pressures on our ringgit and outflows. The 2016 measure had what we call all those capital flows at risk had flew out.
Yeah.
So what remained in our domestic market were the more stable holders of our bond market. And in a way, that saved us in 2018 also, because then the depreciation pressures and the outflows pressures that we had experienced in 2018 will be much more had we not taken the 2016 measure. So it goes back to, really looking at what is the risk that you're trying to manage and what would be the best tool to manage that risk.
Yeah, Stan, I think let me respond to your question with a question. I think what's just been said in a way is that some capital flows are desirable and some capital flows, especially in certain circumstances, are undesirable. And we can perhaps measure them with metrics of capital at risk. I think the question of instrument that you raise is, are there instances where macroprudential policies can help you differentiate the more valuable capital flows, the more valuable capital flow moments, let's call it, so that so your policy doesn't dissuade in some sense or disincentivize the useful capital flows?
Well, I mean, that's reasonable enough. I'm trying to think of something that's really gross, and you're all permitted to say don't speak about this ever again. It seems to me that if you're the United States or the European Union or something big, you'd better have capital markets that can handle the flows of capital that you have to deal with. And if you're a small country and they pick on you every X years or every now and then, you're entitled to intervene in the new set of rules of the fund. Because I think if everybody was permitted to intervene in that way, we'd have a much more difficult system to manage than we currently have. But wearing my Israeli hat, which, not for religious reasons, I should say, I couldn't imagine that the interventions that would have come in 2009 would have been handleable, whereas big countries, it was kind of like nothing much.
Yeah. I'm not sure your hub and spokes approach would pass muster with Raghu. Maybe you could say a few words about that.
It's all right. Raghu and I have an agreement. He tells me when I'm allowed to do things.
So, look, I think the reality is that we're away from the pristine world we had, or we thought we had. It's a far uglier world, and we have ugly policies. Certainly at the emerging market end, we meddle in various things because there's no clean way of trying to deal with these inflows. So we intervene in the exchange rate so as to build buffers when it's coming in. We try and put limits on leverage. You can't lever more than a certain amount. We try and limit certain kinds of foreign inflows. I think even in the midst of this ugliness, it's important to remember you don't want to scare off foreign investors. And so the idea that whatever you do has to be defensible and shouldn't be changing the terms of the contract vis-a-vis existing investors. They have to know that you're adhering to whatever contract you had with them up front. Yeah. And so I think it's really a mistake to put in place constraints, for example, on outflows, because you are changing the terms of the contract and they remember down the line. At the same time, I do think the sense of asymmetric responsibility that I think Stan was going towards sort of makes sense, that when you have deeper financial markets, when you have more liquid financial markets, and you can allow the exchange rate to take some of the impact of capital flows without a huge movement, whether at that point you perhaps have somewhat greater responsibilities to avoid abrupt actions of the kind that some of the smaller emerging markets do. I think that's certainly worth thinking about. The other aspect is, I mean, we still haven't come to the issue of how do we deal with the sending country problem. And I think that, I mean, again, it would be, we need far more research on this to understand what can be done and what kinds of circumstances, and of course the association with the domestic sort of business cycle and the financial cycle. But is there a possible aim at some point to come up with a menu under these circumstances? Don't even worry about what's going on outside. Under these circumstances, perhaps you have to pay more attention. And under these circumstances, it's probably fragile enough that perhaps there has to be some discussion of what you want to do given the... I mean, I wonder if we can go towards that, and that will allow for more stable capital flows over time. That's certainly worth thinking about.
Thank you. It's a tall order, but I think we should think about it. Mark, I'll come to you in 1 minute, but Elvira, on the question of the use of macroprudential measures, are there ways in which you in Russia have been able to try to attract certain capital flows or amounts and avoid others? Do you view that as an objective of policy?
I think in general capital inflows is good for the economy if it boosts economic growth and productivity. But when we see this capital inflow at the late stage of cycle, it can only accelerate the overheating, and that's why we need to use macroprudential measures, first of all, to keep the leverage under control. I repeat that it's the most important thing. If I may, one remark.
Please.
About these interventions in currency rate to smooth the currency volatility through cycle, not in the case of sharp or severe risks for financial stability, but we are discussing how to move this long-term volatility of exchange rate. I'm quite doubtful about this because we don't know what is the equilibrium exchange rate. And if we start intervening in this case, we can see a significant deviation from fundamentals. Yeah. And the mistake of central bank can be huge. The second thing is the communication challenge. When we intervene in the financial market, when there is no obvious risks to financial stability, everyone starts thinking that we are managing the currency rate. And I think it undermines the credibility of central bank, of its the first goal of every central bank, monetary policy, price stability. And I think that it's the main goal, and we should think how in this not simple framework, but integrated in inflation targeting, not to forget about our first goal. Yeah. That's why I think it's very important, and the communication is very important. But macro-pro measures, they are tricky as well. I remember that recently we discussed how we can explain these monetary policy tools combined with macroprudential tools. And the markets and general public don't understand clearly how we use these tools or those tools. But I think maybe my main message not to forget about this transparency of the policy of central banks when we try to accomplish so many goals.
Yeah, I'm glad you remind us. I think the issue of, the question that's often on my mind is how, if you really need different policies for different situations, how you maintain credibility and clarity of the policy regime when you need to switch it up the way we've been talking about. We have no time left. Let me give you, Mark, a couple of minutes. You can have the last word.
Okay. Just a couple final quick observations. One is, the asymmetry point very clearly comes through on the way in as opposed to the way out. But that's also true of prudential and macroprudential. It is, in an absolute reversal of the lean versus clean doctrine or clean versus lean doctrine on monetary policy, it is much easier to lean on the macroprudential side when times are good, when things are moving. And that is also, as you know, Vera, that's easier to explain to the general public because there's not that restriction. And of course, and the biggest challenge is is not doing enough because you're leaning against the counterfactual. So that's one point. Second is, you know, I guess the question, is it an ugly world or is it a world in metamorphosis or transition, right? And it really, you know, emerging economies are called emerging economies for a reason, and there is this huge transition, which is why this issue is coming to the fore, and I guess we're best placed to remind ourselves that. I would in general agree with, you know, directionally that if you have these deep capital markets, and you don't need to be one of the SDR, you know, there are other advanced economies that have the ability to be part of that grouping. But also the responsibility grows with each day, week, month, as the major emerging economies emerge, and that is a responsibility also to deepen all aspects, including domestic financial markets and macroprudential other tools. But the last point I wanted to make is just to, a bit unfair, but well, it's fair enough, pose a question to Stan, because it goes to Raghu's point, and ultimately, and I'll tee it up like this, I mean, the way I think about these issues is that there is the Fed, which in many respects is who we're talking about, or principally talking about, has its political mandate, it's a mandate given by Congress. Its responsibilities are for, you know, full employment and price stability in the US, the dual mandate. It has to then take into account the world. The question is, to what extent is the world spillbacks in its reaction functions, and how quickly is that changing? And so I'm simplifying, but that's my take on it. So if I may turn to Stan and ask him, who also sat and made these decisions, to what extent in the Fed's reaction function did you weigh the spillover, spillback consequences?
That's fair, and since Stan has seniority in this building, he gets the last word, so let me just say ahead of it. I suspect that Raghu still thinks the Fed should have responsibility, even if the spillbacks are modest to the United States. They should have a responsibility to...
Well, spillovers versus spillbacks, that's the question Mark is asking. Should you be concerned about spillovers at all, or only about spillbacks? The domestic mandate says spillbacks. Yeah. And whether in some future world we should be moving towards spillovers.
And my point, if I may, is in a political economy, I mean, I read a very good book called The Third Pillar the other day, and in the political economy and in subsidiarity, it's very difficult to have that world that you just described.
Of course. So. Hoist with my own petard.
Sorry, your own pillar, yes. We'll put you back on a pillar, yes.
Professor Fisher, you get the last word.
Okay, I could think of only one example that I think did influence our thinking. It was the fact that the Mexicans were using the capital markets to intervene in a very predictable way. They sold what were they? They were derivatives of some sort. I don't know.
Tesobonos.
Not tesobonos, the ones that they sold when they were trying to affect the exchange rate.
Oh, you mean this was NDFs?
Yeah, right. I think I took that more seriously because they thought about the market, they thought about how this thing was going to work and so forth. Right. And I can't think of others that met that requirement while I was here. But my guess is if you say, yes, they're going to intervene, but it's in a form that is A, logical, and B, sensible, and C, people understand it, then I think you'd start saying, well, that one is okay. We can live with that one. But I'm not sure when push comes to shove, whether they'll agree with what they've said they will agree with.
Yeah.
Well, thank you for sharing your experiences, your ideas, your wisdom, and giving us all a lot of homework. Thanks to everyone.
Thank you.